In a recent speech to mutual fund distributors at an IFA Galaxy event, Sankaran Narain of ICICI Mutual Fund made a devastating attack on mid and small cap investments. And here's what he said. It is very rare to have fund managers speak so frankly about their views on particular market segments because usually AMCs cater to all kinds of investment needs. They have to accommodate for people who want to invest in large caps, mid caps, small caps, equity, debt, gold, and so it's difficult for them to indicate a strong preference. But Narain's speech was as strong as you can possibly see from the CIO of one of India's largest mutual funds. So what exactly did he say? The first thing that he pointed out was this giant transfer of risk. He said that in 2007, 2008, the risk was largely being taken by banks who were, lending out money too freely, money that was being lent out often for acquisitions abroad. And all of that eventually led to a debt crisis. But this time around, he said that the risk is being taken by mutual fund investors and distributors who are putting in money in mid and small cap funds and therefore into mid and small cap stocks. The risk is transferred there. Companies, he said, are avoiding, bank balance sheets are healthy. Companies are not going to banks so much to raise money as to the capital market, to the stock market. They're doing IPOs, and the people who are buying these shares, taking on the risk, are the retail investors, not the big banks. The second pillar on which he rested his argument was valuations. So he said that if you look at it from any point of view, the share of market cap that mid and small caps have taken compared to large caps, the profits that they generate compared to large caps, the P ratio around 43, however you look at it, the valuations of small cap and mid cap are, as he said, to put it in his word, absurd. The third thing he talks about is behavior. So normally, SIP is projected as this magic solution to all problems. You do an SIP for the long term and you're good. Narain says no. Narain says that if you do an SIP in an overvalued asset class, you are in trouble. There is no excuse. And he has given examples of periods like 1995 to 2002 when SIPs gave a negative return. As also in the pre-2013 period when again SIPs didn't do really well. So his point is you can't just blindly do a SIP, you have to do a SIP in an undervalued asset class. Now he qualifies that. He says that if you do a 20-year SIP then you might still be okay, but how many people actually do a 20-year SIP? He points to one of his own funds, Value Discovery, where he says hardly anyone would have done a 20-year SIP. It would have delivered brilliant returns, but nobody has the patience to wait that long. That is the reality of our market, our investor base. The fourth thing, or the fourth point he makes, is that in comparison, large caps are quite well placed for a couple of reasons. One is that they have not soared as much as small caps. Valuations are not as expensive. FPI, they have borne the brunt of FPI selling, and if FPIs come back, then large caps will gain. And most importantly of all, the macro picture, India's macro picture is largely healthy, and this too will stand to benefit large caps. He's also bullish on hybrid funds, but for him, mid and small cap funds, even SIPs in them, unless you're going to do a 20-year SIP, is an avoid.